wabarakatuh.
Hello ladies and gentlemen, let me introduce myself. My name is Aimee Hawiisa Novee.
My name is Hanifa Aziza
Today we will explain to you about balance sheet.
and the statement of owner equality.
Here we go. What is a balance sheet? Balance sheet, or the statement of financial position, is statement that report assets, liabilities, and equity of a business or other organization at a particular point in time. A balance sheet can also be described as a snapshot of company's financial condition. There are three important elements in the balance sheet, namely asset, liability, and equity. The following is an explanation of a balance sheet elements. The asset section and the liability and equity section. More in detail. The asset section is comprised of current assets and non-current assets. Main current assets are cash, account receivable, inventories, and prepaid expense. The current assets are called such because they are usually on the balance sheet for 1 year or less. The current assets are usually listed on the balance sheet according to their degree of liquidity. Therefore, cash is the most liquid, while prepaid expense the least liquid. Cash is available at any time. Account receivable is sum of money to be received from customer, and inventory is a list of goods to be sold. Prepaid expense is some paid-in expense. The non-current assets are also called long-term assets. Indeed, those are assets that will stay on the balance sheet for years, such as plants, equipment, furniture, and so on. On the other side of the balance sheet, we have the liabilities and equity. Liabilities are composed of current liability and non-current liability. Current liabilities stay on the balance sheet for less than a year. Non-current for more than a year. Let's see the main current liabilities. Accounts payable, sum of money not yet paid to supplier that will be wasted away. Unpaid. Accrued expense is sum of money to be paid in the future, such as payrolls or tax. The main non-current liability is long-term debt, such as loan contract with the bank. Then, the equity. In this subsection are report items such as owner's equity, retained profits, and other kind of stocks issued by the organization. For the example, so you're starting a business, you go to the bank and get a loan. On your balance sheet, this loan shows as liabilities it has to be repaid to the bank. It also shows as an asset for the same amount, as you have the cash to spend. Thus the balance sheet is balanced. You need to buy a computer for your new business. The cash in your asset decreases, but your new computer asset helps balance this. As you sell to your customer, your profits are recorded as retained earnings in the equity section. The cash from these profits is recorded in the asset section, and the sheet remains balanced. Every month you make a loan payment to the bank, your liabilities reduced by the amount of the payment, and your cash is recorded by the same amount. If at any point you need to find out your business worth, go back to the formula from before. Assets minus liabilities equals equity. Forms of balance sheet reports. Sometimes in learning something like a balance sheet, we only know one form, when in fact there is one more form. Not only the balance sheet, some reports in financial statement have the form of one or more than one. The balance sheet has two forms, namely the form of staple and control. So, therefore clearly let's look at reviewing the balance sheet from below. Control balance sheet. Balance form T are called account form. This balance form balance is also called form balance sheet T. Why? Because the arrangement is side by side with the group of assets, left and debt, and capital liabilities on the right. Let's look at the balance sheet form for honest service companies. Balance of staple form or report form. Why is the staple form balance sheet referred to as the report balance sheet? Because the shape of the order is sequentially from top to bottom in sequence. The report form is arranged sequentially from the group of assets at the top to the lowest debt and capital group. Honestly, the service has made a balance sheet in this control form as above. How is the balance sheet from the staple? Not the balance sheet in the form of staple at the company. In conclusion, the balance sheet is one of the main financial statements. It's like an instant picture and it helps us to assess how risky a business is. In fact, when a company is too indebted, you can see it from the balance sheet. If liabilities are too much in comparison to equity, this can be very dangerous for a business.
What is the statement of owner equality? The statement of owner equality is a financial statement that reports the change in the equity section of the balance sheet during an accounting period. In other words, it reports the event increase or decrease stockholder equity over the courses of accounting period. The statement of owner equality is one of the shorter financial statements because there are not many transactions that actually affect the equity account. It typically lists the net income or loss for the period along with the owner contribution or withdrawals during the period. The report itself is presented in a simple equation style format like beginning equity balance plus net income or owner contribution less net loss or owner withdrawals ending equity balance. The ending equity account balance is always carried forward of the following years and become the future year's beginning balance. Obviously, the first year a business is started, it will not have a beginning balance. Hey ladies and gentlemen, we think that's all our explanation today, and we will hope our explanation will be useful for you. Thank you and see you in the next event. Wassalamualaikum warahmatullahi wabarakatuh.